Hey, how's it going, everyone? I'm going to be honest with you. CVS was not even on my radar or watch list because out of all the healthcare companies out there, CVS is near the bottom of my interests. However, the company has just reached a new 52-week low stock price, and they're about the same price that they were back in 2019. So right here, like back in April of 2019, they traded for $56 a share, and they're currently trading for about $56 a share, which is pretty wild to think about because back in January, they were trading for about $81 a share. How did this happen? What's going on? So I'm trying to figure out if it's a good or a bad time to jump in. I mean, for crying out loud, their PE ratio is a single digit of only 9.8. So I'm curious if I will still be uninterested in CVS by the end of this deep dive. So in this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if CVS is a delicious or a disgusting dividend stock. So this is a channel that is focused on dividend compounders. So let's go ahead and check out their dividend profile over the years. So right now, their dividend yield is sitting at 4.7%. But is it sustainable? Yes, it is. Their dividend payout ratio is 41%. And CVS is currently growing their dividend payout by 6.5% year over year. So when we look at their 2014 dividend payout, it was $1.25 a share. You fast forward throughout the years, and now you can expect $2.66 in dividends for every share of CVS that you own. But I do want to call out that their dividend did not grow at all from 2017 all the way to 2021. It stayed flat at a rate of $2 a share in dividends. Now let's take a look at their performance for the past 10 years because the total return is really important. It's going to help us to see if it's a stock that performs well or if CVS is a value trap. And we're going to be comparing CVS to a benchmark, which is the market, the S&P 500, and the index fund for that is going to be VU. So if $10,000 invested in January of 2014, roughly 10 years ago, that principal amount for CVS would have grown to $12,300, which gives us a CAGR, compound annual growth rate, of 2% year over year. That's pretty bad. Because when we compare that to the market, $10,000 in the exact same time period would turn into $32,000, which yields a CAGR of 12% year over year. And when you look at their annual returns, the blue is CVS, red is VU. It looks like for the most part, CVS has been in the red for a majority of the decade. Whereas when we look at the market, they were only in the red back in 2018 and in 2022. Other than that, it was smooth sailing for the market. Now here's the thing. In CVS's best year, which was back in 2021, they grew at 54%. On the flip side, during their worst year, which was 2016, CVS did go down by negative 17%. In comparison, the market went up by 31% in their best year, which was back in 2019, and they went down by negative 18% back in 2022. Next, let's go ahead and take a look at their business profile and how they make revenue. So what exactly is CVS? They were founded in 1963 in Massachusetts as the Consumer Value Stores, aka CVS, and they were a retail business that sold health and beauty products. And since then, they are a business that has continued to adapt and change its business model to stay relevant. And check out this statistic. About 85% of Americans live within 5 miles of a CVS. Today, CVS is a complete healthcare company. And I say complete because not only do they provide the pharmacy and primary care services, but they also cover the insurance portion. So it's a complete loop from start to finish of the medical care process. The weakest part of their business, believe it or not, is the retail arm, but it's also where folks go to get their prescriptions filled. And in the past 5 years or so, CVS has been making very aggressive acquisitions. Let's go ahead and take a look at what is under their umbrella. This past year, they launched Cordavis, and Cordavis is a pharmaceutical manufacturing business that mass produces drugs that have expired patents. So whenever I go to Costco, I buy their allergy medicine about once a year because I can get like 400 tablets for roughly $15. Whereas if I were to buy the name brand Claritin or Zyrtec, it would be like $15 for 40 tablets. So basically, that's what Cordavis does. Right now, they're mass producing Humira, which is a drug that lost their patent in 2023, and it's a drug that helps treat arthritis. And that drug used to be exclusively produced by AbbVie, but now CVS will be able to manufacture those drugs for a fraction of the cost and pass those cost savings down to the customers. And then in March of last year, they acquired Signify Health, which is an on-call, in-person health services business. So instead of an elderly person going to the clinic or hospital, the Signify medical staff go to their house instead. So the best way I can describe it is think of DoorDash or Uber Eats, but with health professionals. However, not only that, CVS also has healthcare providers in physical locations, which brings me to the next acquisition. They acquired Oak Street Health, which is a primary care provider that's essentially located in areas where patients are on Medicaid or Medicare. So like if you are feeling a fever and your stomach is hurting and you need urgent care, you would drop into an Oak Street clinic and be seen by a physician's assistant. Which, funny story, when I was contemplating pursuing my MBA, I was giving some thought and reflection to whether or not I wanted to be a PA because the starting salaries are about the same. However, I just could not get over the idea of potentially having someone right in front of me just sneezing everywhere and me getting sick as a result because I'm a germaphobe, so I decided to go with the business route. But anyways, this is where their economic moat is growing because their competitors such as Walgreens and Walmart are leaving this space altogether, which means they're closing down all of their health clinics, which is pretty interesting because one time I actually got my flu shot at a Walmart health clinic while I was doing some grocery shopping, and I thought that was very convenient. So as of right now, CVS is on pace to open up about 60 more locations for this year. But let's talk about their debt, because I'm going to be honest with you, usually when a company has this much debt, I'm immediately turned off. Like imagine going on your first date and your interest across from you lets out a loud fart in the middle of dinner, right? That's pretty disgusting. And when we look at their debt, it's pretty concerning, right? It's almost $80 billion. And that's because right now, if you look at the left side of your screen, CVS is in this transformative period of their business where they're acquiring and launching more and more companies to expand their healthcare moat. And when you think about their cash flow, which we're going to be taking a look at here in a little bit, I don't see too much concern. Although the number is pretty big at $80 billion, and it's kind of scary, right? If they really wanted to, they could probably pay it off within 5 years. So to me, it's scary on the surface level, but it's not too bad because it's manageable. It reminds me of Walmart back in the 1980s and the 1990s when investors were grilling them for building their supply chain network and transportation infrastructure. Walmart was piling on the debt in order to future-proof their business operations. They were buying up trucks, building up distribution centers, and spending a lot of money on warehouses. Whereas their competitors, when we think about Kohl's, Kmart, JCPenney, and other retailers, they were not doing this. Walmart had a vision for the future of having a sustainable ecosystem that made sure their shelves would always be filled with the merchandise the consumers wanted. And fast forward 30 years, that bet paid off for them. So when I think about CVS, I like what I see. I mean, I don't like their debt, but it makes a lot of sense to me. They're making an investment right now. Not too long ago, CVS was only a retail pharmacy business like Rite Aid, who is currently bankrupt. However, right now, CVS provides a fully complete healthcare service. So their business model and economic moat is low-key on the antitrust monopoly level. Not only do they make the drugs, but they prescribe the drugs from their pharmacy, and you pay for the drugs using Aetna as health insurance. My goodness, that sounds ridiculous. Aetna, by the way, is CVS's health insurance business. And CVS just posted their Q1 earnings for this year, and let me tell you, it was not pretty. As a matter of fact, their stock dropped from $68 a share to $54 overnight. Their earnings per share was $1.31, and the analysts predicted $1.69. That's what they wanted to see. They missed by over 38 cents. Their actual revenue was $88.44 billion, whereas the analysts forecasted $89.21 billion. Now hear me out. Even though the revenue was a miss, I do want to call out that it was a 3.7% increase from the year prior. And we'll get into the why they are struggling here in a little bit. Stay with me. The leadership team also had to downgrade their company forecast for the rest of the year. Now they're expecting an earnings per share of $7, whereas the previous expectation was $8.30 a share. The expected revenue forecast is now $369 billion, which I think it's still fantastic, but it's not enough for Wall Street. To put it into perspective, last year they posted $357 billion in revenue. So if they do in fact hit this $369 billion, that would be a 3.4% growth year over year. And for me, it's like, at least they're growing in the right direction. Sure, it's not $375 billion or whatever they wanted, and it's only $369, but we're still talking about a third of $1 trillion here. This is insane money. But the big reason as to why CVS is dropping like it's hot is because they straight up told investors that the costs for Medicare are a lot worse than they had anticipated. More and more patients are opting to use their health insurance as it was intended to get surgery and treatment that they have been putting off since the pandemic. Because I remember during the pandemic, they were telling people like, hey, if it's not a serious emergency, then please refrain from seeking treatment. And I'm sure a lot of elderly folk decided to just wait a little bit. And because the elderly folk are choosing to get life-saving surgery now, those bills are smacking CVS right in the booty hole all at once. And check this out. The recorded medical cost ratio, which is the percentage of premiums spent on healthcare, the recorded medical cost ratio was 90.4% for this quarter, whereas last year it was 84.6%, meaning that 90% of the premiums that they charged were used for medical costs. This is the exact same reason as to why Humana's stock price is also crashing. Humana is another health services giant that relies heavily on Medicare being profitable instead of having super low margins like it is right now. And the government recently announced the updated Medicare funding, and it was not as high as Wall Street wanted it to be. I mean, it's enough money to reimburse CVS, right? But with smaller margins. And so what that means is CVS can't charge higher premiums to offset more patients seeking treatment. Does that make sense? If there was a bigger Medicare budget, then CVS can charge more premiums to the government to offset their medical costs and increase their margins. So in lieu, Aetna is looking to slash benefits for their patients. That way, there's going to be less medical costs associated with each customer. Take a look at this right here in the bottom of your screen. But it's not all doom and gloom. Their health insurance arm of the business, including the whole Medicare cost being a heavy burden saga, actually posted $32.24 billion, which was an increase of 24% compared to the first quarter of 2023. As you can see, the growth pillar for CVS is really contingent upon Aetna. But if you look at their operating income, which is right here, it decreased by 59% year over year. And here's the crazy number that made Wall Street throw their poop at CVS. Medical costs were $900 million above Aetna's expectations. That's pretty wild to say the least. That means a lot of people are choosing to seek treatment that they did not anticipate, which is wild. The company's health services arm of the business generated $40.29 billion. We'll just round it up to 40.3, which was a decrease of 10% from the year prior. Wall Street did not like hearing that. From doing a deep dive in their annual report, I found out it's because they lost 140,000 potential clients when Tyson Foods decided to drop CVS as their pharmacy benefits manager for their employees. A PBM is basically employee-based health insurance for prescription medicine. And not only Tyson Foods, but Blue Shield of California also decided to drop CVS. The pharmacy benefits manager program from CVS, by the way, it's called Caremark. And let me tell you, Caremark is hurting right now. So for this quarter, Caremark processed 462 million pharmacy claims, whereas last year they processed 587 million pharmacy claims. That's a pretty dramatic decrease. On the flip side, Cordavis, Oak Street, and Signify Health are doing really well. So I think going forward, their revenue growth for this pillar of their business is going to be seen in their acquisitions. The retail arm of the business, the physical buildings you think of when you hear CVS, well, they reeled in $28.73 billion in revenue, which was a 3% increase year over year. I think that's very modest numbers for a retail operation. I think that's why the Aetna acquisition back in 2018 was so smart for the future and health of CVS. Because when you look at Walgreens and Rite Aid, look at what happens to a retail pharmacy company when they do not diversify their portfolio. Both of those companies pale in comparison to CVS. But if you dig deeper behind the numbers, the reason why their revenue did not grow as fast is because they closed unprofitable store locations. So right now they have about 9,000 physical locations, okay? Meaning they increased their revenue with less stores outstanding. Their same-store pharmacy sales went up by 7% year over year. Their same-store prescription volume went up by 6% year over year. So they're doing more with less stores. And I think what's really funny to me is when we think about CVS, we think about their 24/7 physical stores, right? That's always understaffed and the bright white lights. But according to their balance sheet, the retail arm of the business makes up the smallest slice of the pie. So what are my overall thoughts on CVS and their most recent earnings report? Well, Walgreens and Rite Aid shows that physical retail pharmacies are a dumpster fire. If you're really curious, just look up their respective stocks. It's hideous. But CVS is way ahead of the curve and is going through a business transformation. They're trying to become like United Health. CVS wants to turn into a one-stop shop as a healthcare provider with their clinics, medical staff, pharmacy, and insurance. The reason why United Health is more successful than CVS is because they are a health insurance giant that decided to branch out to become a diversified health services provider. On the other hand, CVS has its roots as a physical retail pharmacy trying to branch out and doing the same thing. And their base point is horrific. A retail pharmacy, not a good business model, but they're trying to pivot into becoming something that is amazing with double-digit margins. Now, here's why I feel sort of bullish on CVS. Imagine if they were to slowly transition their retail stores from selling makeups and overpriced candy to becoming healthcare centers for their Oak Street urgent care centers or expanding their minute clinics. Honestly, I feel like that topic needs to be a part of the conversation with the leadership. Alrighty, next let's go ahead and take a look at some numbers. First up is going to be the revenue. Investors call this the top line. So back in 2015, they posted $153 billion in revenue. And as we fast forward throughout the years, it does in fact look like they have been growing it consistently, and sometimes it even goes up by double digits. Based off of revenue alone, this is simply amazing. And it looks like for the past 10 years, CVS has been increasing their revenue by 10% year over year. So I can see why Wall Street is disappointed with them with a projection of only 3.4% growth for this year. However, when we look at their net income, this is what investors refer to as the bottom line. It is not the same story. It is very inconsistent. Back in 2015, they posted $5 billion as their net income. However, as you fast forward throughout the years, back in 2018, they turned up negative, but then they recovered smoothly. And then in 2022, they went down by negative 46%. They posted, $8 billion in 2021. And then the next year, they posted $4.3 billion. So very inconsistent. And this is not what I want to see. However, it is headed towards the right trend. And what I mean by that is 2015 was $5.2 billion. And as of last year, their net income is $8.3 billion. So it's headed in the right direction, but all the years in between, very inconsistent. We want to see a little more stability. And now we made it to my most favorite part of the video. We're going to run some valuation models to figure out what exactly is the intrinsic value for CVS. That way we can figure out if it's undervalued or if it's a hot dirty mess.
Well, intrinsic value, in other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
And the first one is going to be the multiples valuation. Essentially, we're going to figure out a market-derived price for CVS based on their industry peers. So when we take a look at these other healthcare services providers, their median PE ratio is sitting at 20.5. And when we take that into consideration with CVS's current earnings per share of $6.50, $1.47, this spits out an intrinsic value of $132.89. Moving right along is going to be the discounted cash flow analysis model. Essentially, the free cash flow is going to tell us the intrinsic value for CVS. So back in 2018, CVS posted $6.8 billion as their free cash flow. You fast forward to the next year and they went up by 52%. And during the pandemic, they went up by an additional 29%. And then they went up by 17%. However, in 2022, as we saw from the net income, not a good year for CVS, as their free cash flow went down by negative 14%. And as of last year, they also went down by negative 22%. However, when we take a look at their history collectively, the average growth rate for their free cash flow is sitting at 12.2%. Now, the Wall Street analysts are predicting that CVS will grow their free cash flow at 10%. However, I want to play it safe and be conservative. So I'm going to use 3.5%. And this 3.5% is a number that is based on what the leadership predicts their growth is going to be for this year. I think it's actually closer to 3.4%, but we're going to round up a little bit because the numbers and data says 12%, Wall Street says 10%, and if I plug in 3.4%, I feel like that's a little too bearish. So we'll give them a 0.1%. So we're going to plug in a 3.5% growth rate of their free cash flow year over year going forward. So taking that number into consideration with some balance sheet numbers, the DCF price for CVS is going to be $99 a share. The next valuation model is going to be the dividend discount model. Essentially, the dividend growth rate is going to tell us an intrinsic value for CVS. So like I said earlier, from 2017 to 2021, CVS did not grow their dividend. They just kept it steady and flat at $2 a share. However, since 2022, they have been increasing it. And CVS has been increasing it at a rate of 10% year over year. However, I do not want to be that generous. So instead, we're going to divide that 10% by 2 and plug in 5% into the formula instead, because I am taking into consideration how they did not grow their dividend at all from 2017 all the way to 2021. So worst comes to worst, I feel like it's in their DNA to just freeze growing the dividend. I don't think they're going to cut it. However, there is a possibility that the dividend is going to be frozen at $2.66 a share going forward. So on the basis of their dividend growing at a rate of 5% year over year, that's going to give us a DDM intrinsic value for CVS, $93.10, which brings us to the bear model, the Benny Graham's valuation model. He never lets me down on giving me the lowest number. And I like to include it in my models because it's kind of like a sanity check. If I only plug in bullish numbers, then I might be acting delusional. So this number is going to spit out an intrinsic value for CVS, $57.26. Remember, right now they're trading for about $56, and last night they actually dipped down to $54 a share. So 57 is not too crazy, which brings us to the conclusion. What is the intrinsic value for CVS? Well, Jimmy, you know the people need their drum roll, so give it to them. The intrinsic value for CVS is going to be $95.60. Let's compare that number to what the Wall Street analysts believe CVS is worth. So Wall Street thinks that CVS is worth $86 a share. The low estimation is $58 a share, and the high estimation is $106 a share. So we said $95, Wall Street says $86. So after hearing everything and understanding their numbers and their future, I'm curious, right? I want to figure out what is an acceptable buy price. And to do that properly, I want to bake in a margin of safety.
We don't think we need a huge margin of safety because we don't think we're going to be wrong. When we see a great business, it's like if you see somebody walk in the door and you don't know whether they weigh 300 pounds or 325 pounds, you still know they're fat, right? And so if we see something where we know it's fat financially, we don't worry about being precise, and if we can come in that particular example at the equivalent of 270 pounds will feel good.
So with a 10% margin of safety baked in from their current trading price of $56, well then the acceptable buy price from this intrinsic value is $86 a share, which means if you were to buy in right now, you get a discount of $30. Now let's say because the future of CVS is a little shaky, we want a bigger margin of safety. Let's go ahead and plug in something like, I don't know, 30%. With a 30% margin of safety baked in, then the acceptable buy price becomes $66 a share. And if I were to buy CVS at its current trading price of $56 a share, well then the margin of safety that I get is 41%. Now I plugged in the Wall Street Analyst price target for CVS, which is $86.26 a share. With a 20% margin of safety baked into this intrinsic value, then the acceptable buy price is $69 a share. With a 30% margin of safety, then the acceptable buy price is $60 a share. So no matter what number we throw at it, CVS is currently undervalued. However, when I take into consideration their total returns for the past 10 years, it's not a pretty picture. So there's a lot of factors and variables I need to reflect on. So you're probably wondering, what is my overall opinion on CVS? Here's where I am coming from. I absolutely despise the health insurance industry. But when it comes to investing, I have learned that it's best to turn off your personal feelings when it comes to winning businesses. Likewise, I have also learned to not fall in love with dumpster fires. Just because I love it, it does not mean that the company is going to do well. So looking at CVS objectively, I'm going to be transparent with you. I think I'm going to start a position in CVS once the fog clears. I'm not sure what's going to happen to them in the near term. I'm talking about in the next 3 days, next week, or even next month. Their stock price could potentially keep falling. Or it could rebound like it did with United Health. With that said, I think CVS is absolutely undervalued for the time being. Their PE ratio, right? Their trading multiple is literally a 9. And here's the thing. I don't think it's a dividend compounder with cheese, but I do think that it's a decent company. It's in between being disgusting and delicious. It's just decent. Prior to making this video, I actually had no idea how much cash CVS was generating. So believe me when I say I was super shocked to find out that CVS posted over $350 billion in revenue last year. So I learned that revenue is not the issue for CVS. Their revenue is growing at a tremendous rate. So the issue is not revenue. Rather, their focus and priority should be increased margins. Can they turn a bigger profit for every dollar that they make? They made the right strategic acquisitions in the past 5 years. But now the name of the game is about optimizing the operations and hitting the industry average margins. Like if they can get Oak Street Health, Signify, and Aetna up to speed and getting double-digit margins, the potential and limit for CVS is the sky. And when I say all of this, I'm not looking at it as CVS just being a stock. I'm looking at CVS as a business that is going through a transformation. And I'm going to be honest, I actually believe in their pivot if they can execute it well. So it really depends on can they execute this transformation. So with that said, CVS is on my watch list, but I'm not buying yet. I'm going to wait until the fog clears. So please do your own due diligence and research to figure out if you want to buy into CVS or not. Please don't just blindly follow me into it. That has been another video with Dividend Compounders with Cheese. I'll talk to you next time. Stay safe.